Hello, everyone. Extremely excited to have this live session here today. Today, we are going to be talking about something very distinct and very deep. And it's conceptually very intriguing, right? It's about the blue ocean strategy. A lot of you may have heard of blue ocean strategy. A lot of you may not know what is blue ocean strategy. So I'll kind of cover the basics, but most importantly, the important question is blue ocean strategy risky for your business? Because especially what has happened is I work extensively with startups, mostly early stage startups. I help them with growth as well as fundraising, typically from 5 CR to 50 CR range, right? That is the range which I work with. And what I've noticed over the years is, especially in the last 2 3 years, a lot of startups who raised a lot of VC capital, or even those who did not raise a lot of VC capital, right? They ended up shutting down over the last 2 3 years. Primarily, what has happened is because they were unable to find the right market for their product. Because of this, they were unable to grow their revenues, they were unable to sustain their business, and eventually had to shut down. So the question being, considering that startups by definition tend to adopt the blue ocean strategy model, is adopting blue ocean strategy risky for your business? So before we kind of get into that, let me kind of explain what the blue ocean strategy is, to give you a bit of context of what that is about. A blue ocean strategy, typically what it means is you have two kinds of markets. One is blue ocean strategy and the other is red ocean strategy. A red ocean, what that means is it's an existing marketplace which has thousands of competitions or thousands of competitors already in the market, already offering the services. Everything is pretty much going along the lines and everything is along the status quo. What happens in such a market is, the reason why it's called red ocean is because each and every competitor is like a shark, and everyone is kind of bleeding into each other, taking away from the competition. you know it's extremely there's a bloodbath, how competitive the market is. And that is why the name is red ocean, because it's so competitive that eventually each and every product becomes commoditized, and you become simply competing on price. So that is red ocean. So that's why this theory was posited of blue ocean strategy. What blue ocean means is, instead of competing in the red ocean with a huge tremendous amount of competition, you operate in a blue ocean where essentially the competition is very limited, the market is already there. You need to figure out how to cater to that demand in the right way, so that that generates business for you, right? So principally, you might think that obviously it would make sense to do a blue ocean and not a red ocean, right? But there are a lot of similarities and differences which you need to kind of think about before you decide how to kind of do the blue ocean, right? Because in blue ocean there are different degrees of blue ocean as well, right? One would be like completely brand new innovation which is not there in the market at all. A completely groundbreaking innovation, something like Steve Jobs used to do with the iPod, the iPhones, the iPad, right? He completely created new categories from scratch. So something along those lines. Very few people in the world have been successful in creating such completely new categories altogether. If you look at it, how it works, right? To create a completely category creating company, like say an Apple or a Google or a Facebook or an Amazon or an Uber for that matter, you need to kind of disrupt the existing industries. The underlying philosophy is always there, that the market demand is always there. It's not like they are generating new market demand, but the way that they're catering to the market demand is very different. So, for example, when Amazon started going online, it's not like Amazon created the demand for people to buy stuff. People were anyways buying stuff. He simply offered a new channel to buy stuff from. Same goes for Uber. People were already buying cabs. They were renting cabs for wherever they wanted to go. But Uber gave them an easier way to kind of book cabs. Same was true with PayPal. PayPal was a very simplified payment system. So the idea regarding the disruption over here is, the demand is already there in the market. You are innovating through different models to ensure that you're different from the red ocean, and now you're operating in the blue ocean. Now the degree of innovation which is there, that determines how deep the blue ocean is, and how risky it's going to get. Amazon, to be honest, Uber, to be honest, these were extremely risky businesses when they started out with, and that is why they needed tremendous amounts of capital. uh, these companies are notoriously known for raising billions of dollars to kind of reach the stage that they are today. So that because of the nature of the innovation, how big the innovation was, they were able to do something like that, and they were able to execute on that. So realistically, when you're looking to adopt, how deep that you want to go, I personally would suggest not go as deep innovation as these big players, because unless you have access to that kind of capital, you have the right relationships with the right investors. And even though there are people like me, there are other bankers like me, we help startups raise funds. But for such a groundbreaking idea, you need to ensure that you have sufficient capital to begin with, that so that you can prove a certain amount of traction in the place already in the market. Because if you don't have that traction, it's going to become very difficult to raise capital. So when you decide to take such a huge leap of faith and to do go blue ocean at such a vast level, you need to ensure you have the right resources, you have the right capabilities, you have the right skill set, you have the right team, you have the right execution capabilities in order to be able to sustain that. Because the odds of a company like this succeeding are very less. So most VCs, when they would invest in 100 companies, they kind of expect that the 90 of those companies are going to go bust and only the 10 will succeed, because they are looking for such moonshot opportunities where it completely not just disrupts the existing category, it creates a completely new category by itself. So that is on the the very deep end, which is complete groundbreaking innovation which happens. But that formula doesn't work for each and every business, as I already mentioned. If you are a small business owner or an early stage startup or a very small startup, right, thinking about such a huge jump right from the beginning may not be the best approach. What you could look at doing is look at minor improvements, minor changes, minor USPs which you can create within the existing market, where you capitalize on the existing market opportunities which is already there, but you bring your own twist to it. Now the twist could be in the form of the product offering, it could be in the form of distribution, it could be in the form of market segment, it could be in form of how you're marketing the product. It could be, there are multiple ways of creating those small USPs within your existing product to ensure that even though you're competing with the existing market and the demand, and yet you have your own identity. And these are the ones who kind of get that initial traction which they want to get that initial results. Because directly jumping into the big ocean and doing groundbreaking things, it's not there for everyone. You need to be have access to that kind of capital to ensure that you survive. But even if you do these small oceans, these small incremental innovations, that will help you differentiate into the market. And once you have certain traction over here, then you could potentially look at doing a significant improvement, and looking at a moonshot goal of completely changing a category. Then it would make really good sense to do something like that. But doing that right from the beginning may not be the best idea. So this is how using blue ocean strategy and the degrees of it would make sense for a startup, right? So you need to kind of evaluate where you are right now, do a complete honest evaluation of do you have the right skill set to go after such a long moonshot idea. Do you have all the capabilities, all the people, all the manpower, all the strategies which you need to kind of adopt that? If not, you could start with a a minor differentiation, a minor USP which keeps you apart from the marketplace. Just like my offering, right? I'm not a marketing agency, I'm not a fundraising consultant, I'm not a JTM partner, I'm not an IPO guy. I have a very different positioning for my services compared to everyone else in the marketplace. And that is what kind of drives the business for me, because of that unique positioning which I have. And that is what you need to create for your business as well. How do you create that unique positioning? I have positioned myself as a GTM advisor and as a very unique kind of a fundraising advisor. You need to think about for your business as well, rather than going for that big moonshot ideas right from the scratch. What minor improvement can you do in your business? What minor USP can you build in your business? Once you figure that out, you'll notice that when you're speaking with potential clients, when they speak with you, they'll feel, oh, this is something different, I've never heard of something like this before. And once you get into that mode, that will initiate a lot of conversations for you, and that will start generating results for you in the long run. Because people will realize that this what you're offering is something completely unique, completely different, and they'll be more than willing to hear from you. So I hope you understood the difference between the different degrees of red ocean and blue ocean. And obviously, it's a kind of a no-brainer that you need to have some element of blue ocean into your business. If you stick to the red ocean, essentially you'll get eaten up by all the rest of the sharks in the market, and they will all cannibalize themselves. So staying in the red ocean is a complete recipe for disaster. You need to have blue ocean elements to it. The question is how much, and that will determine the risk factor. So I've, hopefully this video has been helpful to you. Figure out the right amount of innovation which you want. Doing too much innovation also will require a lot of market education, right? So unless you have that kind of resources and capital, I would advise against going along that route. look at minor tweaks, minor innovations, minor blue ocean strategies which you can implement in your business. Start implementing them quickly, start experimenting with them quickly, start generating quick results. And once you start seeing that, double down on that so you can gradually grow and expand into your marketplace. So I hope you found this video valuable. I've created a completely deep 20-minute GTM training. You'll find that in the pinned comments below. If you enjoyed this video, do have a look at that video because it will help you plan out your entire GTM strategy, because GTM strategy in today's day and age is completely different from what it was 20 years ago. So I highly recommend you to go through this because that is truly going to help you go to the next level and get your product into the market, get it into their hands. So check out the video in the pinned comments, and I hope to see you in the next video. Take care. Bye bye.